Hey, welcome back, everyone. Good morning again, options traders. Well, it's time again for another round of idiotic ideas. We're up to number 8% to double. Now, if you're new to this series, I've gotten these ideas from a book. And as I've mentioned in every one of these videos, I'm not going to mention the author or the book because that's not really my point. Part of the point is to show you why you have to be very careful where you get your information from because the author claims to be an expert in options, claims to have run a newsletter back in the day, and have all kinds of options experience. Sounds like somebody you'd want to follow. But the entire book is just filled with really bad ideas. And so, yeah, I think it's overall usually better to show people what to do, look at things in a positive light. But every once in a while, it can certainly help to look at it from the perspective of what not to do. And so that's where these are coming from. So let's find out more about this idea of percent to double. What is it and why is it such a bad idea? As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So this is a direct quote from his book, and he says that another useful analysis tool for option buyers is a percent to double calculation. This tool tells you how much or what percent the underlying instrument has to move for the option to double in price. The smaller the number, the better play for the option buyer, and the reverse would be true for the option writer. Okay, so he's setting it up as that there's this calculation, and you're going to figure out how much the stock has to move before the option's price will double. Does the stock have to move 2% or 5% or 10%? And what he's saying is that the smaller this percentage move to double the option's price, the better it is for the option buyer, and the worse it is for the option seller. Well, again, this is just filled with complete fallacies and things that are going to get you in trouble. It would be a very long list to even try to tell you why it's such a bad idea. But let me start off with a few of them and show you why overall it's a really dumb idea to follow. So this whole thing with percent to double is a lot of brokerage platforms will show it to you. Used to be a lot more popular way back, but every once in a while you'll see platforms that will show you, or people will just try to calculate it on their own. So here's the first point to consider. Why should 2x or doubling be a goal? As time and news change, decisions are going to change. That's what trading is all about and investing. A 2x goal today doesn't mean it'll be the same tomorrow. Yeah, you could have a 2x goal today, and then tomorrow you're going, gee, I'm going to be lucky to get out at a 50% loss. So just because you have this goal doesn't mean it's going to remain throughout the life of the option. Now, the other problem with having this as a goal is that if the option hasn't doubled, now you'll be tempted to hold because you're saying, well, that was my goal. I've got to hold it until it doubles. Well, again, who's to say that that's going to happen? And then conversely, if the option does double, why should you just sell it when it might be going a lot higher? That's why the Wall Street saying is cut your losses short, let your winners run. If this is one of the stocks, think like Nvidia now, that really takes off and runs, why would you want to cut it short at a double? So the main thing is, why would you draw an arbitrary line in the sand for a goal? Instead, the better way is to make daily decisions based on new information. So that's the first problem. Now, the second problem is, well, the percent to double when. You actually have two time periods to measure. We could look at the percent to double today, or we could look at it at expiration. So of the two, the percent to double at expiration is much easier. So let's start there. Let's start with percent to double at expiration. The nice thing about this is that it's easy to calculate. You really don't even need any software for it. You're just going to take the current options price, you're going to multiply it by 2, and then figure out the percent to double. And this is easy because you're only dealing with intrinsic value, assuming there is any, at expiration. We don't need a pricing model. The problem is that each day the stock moves, the calculation changes. Now, in fairness, you could say, well, at least it gives you an idea of how much movement is needed before we're going to start seeing some type of a significant return in this option. But again, that could quickly change by tomorrow. But for example, let's say the stock is 100 and the $100 call is trading for 3. This is the price that you just paid. So we multiply it by 2. We say, okay, in order to double, that option would have to be trading for 6. Well, if we want to figure out the percent to double at expiration, the stock must be 106. It would have $6 of intrinsic value, and therefore it's a 6% move to get the stock to 106, and therefore the percent to double is 6%. But again, that is only for today. So you might think you've got some kind of a wonderful tool. Oh, I've got a 6% percent to double. All right, well, what about tomorrow? If that stock falls to 97, it's no longer 6%. So that's the really big problem with it, is that it gives traders the illusion or the false confidence that, oh, I only need the stock to move a little bit and I'm going to double my money. It's just an arbitrary calculation. All right, but having said that, let's go see how the math works out. So here's a list of prices from a pricing model. We've got the stock prices down here in this black column at the far left. We have the option prices. So it was set with the stock and strike right here at 100. I believe it was 20% volatility and 30 days to expiration. So it says that the options price is worth 286. To double it, this column would just be 2 times that, or $5.72. And therefore, at expiration, in order for this option to be worth 572, the stock would have to be 105.72, and therefore would need it to move 5.72%. Well, what if we were looking at the 99 strike with the stock at 100? Now we've got $1 worth of intrinsic value. Pricing model says it's worth 337. If we bought this call, to double it, it would have to go to 674. I would need the stock to rise 6.74%. If I buy the 95 strike, pricing model says it's worth 597. All right, it's got $5 of intrinsic value and 97 cents of extrinsic. Doubling that is 1194. I would need the stock to move 11.94%, almost 12% to double this one. All right, so notice what's happening. We're going from about 12%, and as we move down, they start to fall. We hit a point, and then they start to rise again. So the point where it's the lowest is right there. 5.72% is the smallest on the board, and that corresponds to the at the money. And that will always be true. All right, so this is another reason why it's just a dumb calculation. So if we drop to the 99 strike, it's going to be less than $1 worth that it's going to come off because of delta. So have roughly a 50 delta, but you do have $1 worth of intrinsic value to make up. And so that's why you're going to pick up roughly another percentage point. You're going from 5.72% to 6.74%, but roughly another 100 basis points up. And so that's the problem, that as you start going in the money, not only do you have to make up the extrinsic value, but you have to make up the intrinsic value. Now you get really the same problem in reverse as you go to out of the money. If we look at the 101 strike, not only do you have to make up the 240 right here that you paid, but you also have to make up the $1 worth that it's out of the money. And so now that's why it's increasing from 5.72 to 5.8. So you see what's happening. It doesn't really matter what prices we use or what volatility we use, because of the way that options are priced and because of this percent to double calculation. This will always be the low one, the at the money. So if we look at these numbers over here in the far right column against the various strikes, this is what we get. Right? So right there is the lowest point for the at the money. And so you have to say, well, what do we need a calculation for at expiration? He could have just said, buy the at the monies. But they say, no, it's a percent to double calculation. So again, the reason that this is the low is that if the stock is 100, notice that the in-the-money calls must make up for any intrinsic value. And the out-of-the-money calls must make up for any out-of-the-money values. So in a sense, if you're $10 in the money, it's just as challenging to make up the 10 points as if you're 10 points out of the money. So let's say that you've got the 85 strike. In order to make up, let's say for the stock to come up to 100, you've got to make up 15 points just to get it back to 100. Whereas if you bought the 100 call, you just have to make up the extrinsic value. So you've got all this intrinsic value that you have to make up to recoup before you start doubling that option's price. And if we go in this direction, if you've got the 115 strike, you still have to make up 15 points before it becomes at the money. So that's why those percentages are going to be higher. If they're in the money, they're going to be higher. The one that has the smallest percent to double at expiration is the at the money strike. So the thing to take from this is that the percent to double at expiration, the lowest percent to double will always be at the money. Hey, no calculations needed. There's no reason to mask it behind this mysterious percent to double. Now, another problem, now that you see how the calculation is done, the greater the reward, which is what he's boasting about, the greater the risk. We've talked about this many times. The market knows about that. And if there is a potential reward or benefit, you've got to pay for it. So you're saying, all right, well, what's the big deal if I can make the better percent to double? I don't need the stock to move as far. But it's also because I'm taking greater risk. Part of that risk is that at the monies have the greatest time decay. If that stock doesn't get up and moving quickly, tomorrow all bets are off and your calculations are off. All right, so that's the behind the scenes look for percent to double at expiration. Good news is no calculations needed because it's just doubling the options price and finding out how much intrinsic value you would need to double. What if we want to look at percent to double today? So I've got a 30-day option and I want to double it today. Well, this is going to be a little more difficult to calculate because you need a pricing model. Now, you also have to assume no change in volatility. And as always, if 1 day's time passes, the calculation's going to change. And so you have to say, what's the point of it? Now, if we do want to look at the percent to double for today, then the rule is easy. Out of the money strikes will have the lower percent to doubles. Now, this is only true up to a certain point. You can't go so far out of the money that they're trading for 5 cents, even though they're theoretically worth nothing. But I'm talking about out of the money to where they still might be trading for 50 cents or 40 cents. There's still some value to them. So the rule would be simple. Just buy the furthest out of the money strike you can. That will have the best chance to double its price today. But as always, you guessed it, you've got the highest chance for failing to meet that goal. So why is this such a special calculation that's giving you the best chances to succeed? All right, so let's go back to our pricing model. So this fourth column right here, percent to double at expiration, is the one that we saw previously. Here's the percent to double today. So if we looked at our $100 strike, price was $286, doubling it is $572. I would need the stock to be trading for $105.72 or up 5.72% at expiration to double. But today, I would only need it to be up 4.52%, which is certainly less than 5.72, but it's got to happen today. Otherwise, we're back to a new calculation. So take a look at what's happening when we look at percent to double today. If we go to the in the money strikes, let's say the 95, it's 6.8, 6.23, 5.72. Look what's happening. They're continually dropping. If you get a little tiny move in the stock, assuming it's fast and aggressive, these are going to show really exponential returns. So yes, if you go for the out of the monies, that you do have a better chance to double it if, that's the key word, the stock makes a fast, aggressive move, which means what? It's probably not going to happen. So this whole idea with the percent to double, we have to assume no change in volatility, regardless of which calculation you're looking at for expiration or today. If 1 day passes, the calculations change. So really, percent to double is just a wild guessing game. And rather than calling it percent to double and looking at some fancy calculation on a platform, it could really be boiled down to just a couple of rules. If you're trying to double by expiration, buy the at the money. If you're trying to double for today, buy the furthest out of the money that you can. So again, there's no need to mask it behind a fancy sounding calculation called percent to double to give you the impression that you have an edge by using this utterly useless tool. Learn your options theory, your hedges, rolls, and morphs. Learn to manage risk, not profits, and that's when you're going to have your best results. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.